In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about whether India's state discoms are at the cusp of a big change, and finally, I talk about the new age of trade. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Thursday, 18th December. Coming to the first story, a new draft electricity amendment bill is making its way through the system. The changes to the original bill are almost entirely targeted at just one section of India's power grid, which is also the weakest, the state-owned power distributors or discoms. The last mile that delivers electricity from the plant to your home remains a chronic money pit. State-owned discoms have accumulated over rupees 6.77 lakh crore in losses by 2022-23, growing at approximately 7% annually since 2015. To fund these losses, discoms have been taking on debt, which crossed over rupees 7.5 lakh crore last year. Yet, the losses continue, and discoms get stuck in a loop of raising new loans to service older debts. As a result, the government is forced to repeatedly bail them out. Now, these losses reverberate across the entire power ecosystem. Much needed infrastructure investments get delayed, while generators often don't get paid on time. And consumers suffer through unreliable power supply and tariffs that never quite make sense. So, the draft bill attempts to address this by targeting four structural friction points that have plagued discoms for decades. Now, these aren't bugs in the system. They emerged for reasons that may still be valid. But these features have now turned into distortions that need repairing. Understanding them might explain why your electricity bill looks the way it does, or even why reforms keep stalling. Let's break them down. Let's start with power procurement. So, a state discom's job sounds simple: buy power from generators, deliver it to consumers, and collect payments. But it's not the delivery of the power where they're most inefficient, it's the buying part. In fact, procurement makes up 70% of the cost of a discom. Effectively, the biggest reason for why discoms run heavy losses can't truly be controlled by them. To understand why, let's break down how they procure power. See, discoms buy power from generators, typically coal plants, through power purchase agreements or PPAs. These long-term contracts are usually 20 to 25 years long and include fixed capacity charges that don't really change over time, along with some variable costs. So even as operational efficiencies improve, these contracts don't adjust prices much. Because of that, a coal plant built in 2012, for instance, might be charging similar prices even today. As a result, discoms are often forced to buy expensive legacy power even when cheaper alternatives like solar, wind, or even short-term market purchases are available. Additionally, these PPAs are take or pay contracts where payments must be made regardless of whether the power is actually used. And this causes problems in situations where power demand has clearly been overestimated. For instance, if a discom signed a PPA expecting demand to grow 8% annually, but demand grew only 4%, it will still pay for unused capacity. These fixed costs run into thousands of crores annually. On top of that, when energy prices get higher due to a crisis, the generator passes on the extra costs to discoms. Also, power procurement is affected by the capex undertaken by power generators, which can often be inflated. This, in turn, raises the fixed prices faced by discoms. Coming to inflexible pricing. So, the second friction relates to how discoms set the prices you pay. To a degree, we covered this earlier in our primer on how Indian power prices work, but we'll summarize it quickly here. So, discoms follow a cost plus pricing system, which is regulated by the local state electricity regulatory commission or SERC. They calculate their costs, most of which is defined by procurement, and add a return on capital, which is set by the SERC, and that becomes the tariff. In theory, this should guarantee cost recovery. In practice, though, the effect has been very different. For one, without penalties for not meeting certain benchmarks, the cost plus model doesn't incentivize efficiency. If a discom can pass through its costs anyway without consequences, why would it want to reduce them? Losses due to transmission or poor collections are likely to get baked into future tariffs with a regulatory lag rather than eliminated quickly. However, this has been slowly changing with discoms getting more efficient lately. The second issue, though, is mostly out of the Discom's control. Power is a politically sensitive topic, especially during elections. So, Discoms find it extremely hard to pass on any costs passed on to them further to households. The gap between what it costs to supply power and what consumers actually pay gets recorded as a regulatory asset, essentially an IOU to be recovered from future ratepayers. These regulatory assets have ballooned to lakhs of crores across various state discoms. Now, this system of setting tariffs becomes even further complicated due to the friction between the center and state governments on electricity as a subject. In India, electricity sits on the constitution's concurrent list. Both center and states can make rules on it, and this makes reform a pretty hotly contested space between the two. So each state has its own discom and has iron hand control over it. Regulatory commissions, though nominally independent, often reflect state government preferences. If the center tries to push for cost reflective tariffs, but a state government wants to promise free power, it's usually the latter that wins out. Some states have even gone years without any upward tariff revisions, simply rolling over losses. However, at the same time, they've often delayed subsidies that were earlier promised to discoms in order to make up for these losses. And this puts discoms between a rock and a hard place that they find hard to get out of. Coming to the cross-subsidy squeeze. So the third friction is related to the various consumer bases of discoms and how some of them subsidize the others. So broadly, discoms have two separate sets of consumers. On one hand, you have households and farmers who require cheap power. On the other, you have commercial and industrial or CNI consumers who run shops and factories as well as the Indian railways. In many states, the latter set pays rupees 10 to 12 per unit, sometimes more, while the actual cost of supply is around rupees 7 to 8. The difference is used to subsidize households and farmers. And this has long been a rule that India's power sector has followed. The logic of this was equity. Essential sectors and vulnerable groups shouldn't bear the full cost of power. However, this system is now slowly turning unsustainable. CNI consumers are increasingly opting out of these high tariffs, and instead, they're procuring power from third party generators directly. In fact, the Green Energy Open Access Rules 2022 have allowed factories to generate their own power supply. India now has 79 gigawatt worth of industrial power generated captively. Every time a high paying customer leaves, the cross subsidy pool shrinks. Now, how much does this cross subsidization matter? It is true that commercial customers make up quite a small chunk of discom sales, but much of this volume shortfall is made up for in value. As per the CSEP's assumptions, in 2023, the net amount at risk if all overpaying commercial users leave was over rupees 22,700 crore. And most industrial consumers, it seems, have already made the move away from discoms. So, discoms are left depending heavily on their low revenue customers. Besides these three, there are other inefficiencies within discoms. For instance, losses due to transmission are quite sizable. We've covered this earlier. But these are the three major friction points that the bill aims to tackle, and that's what we'll be discussing next. Coming to the policy response. So, one of the biggest changes in the new bill is introducing private competition. It allows multiple distribution licenses to operate in the same area using shared infrastructure. A new private entrant could procure power more efficiently and offer consumers better prices, pressuring discoms to optimize. The bill also hopes to introduce new, more flexible market instruments beyond the standard PPAs. But this idea is also one of the most scrutinized. A major concern is that if most of the costs come from power generation, how effective will competition within discoms be in reducing the rest? In fact, in many Western countries, attempts to introduce competition within discoms have generally yielded mixed results. Additionally, this type of parallel licensing has been tried before in small pockets like Mumbai, but ran into network duplication issues. And it could be far more efficient, the argument goes, to have just one or two operators or look to introduce competition in other forms. Additionally, the bill allows SERCs to exempt their discoms from the Universal Service Obligation or USO if they want. So the USO mandates discoms to supply electricity to all customers who ask for it, including high-powered industrial customers. For that, the discom has to procure more power, thereby signing a PPA. However, this new change hopes to do away with that burden for consumers who use more than 1 megawatt of power. With industrial users moving towards securing power from other sources or even captively, this rule is timely. Now, the bill gets aggressive on tariff setting. It empowers the SERC to revise tariffs if discoms don't file petitions on time. Ideally, this should prevent massive delays from the discom side and instead ensure that the new cost reflective tariffs are applicable starting the next financial year. The era of rolling losses into regulatory assets should, in theory, end. On that note, the bill also streamlines power between regulators, state governments, and the center. So, for one, the bill hopes to create an electricity council, which aims to reduce friction between the center and states on electricity. Think of it as a GST council for electricity. But this is also where things get controversial. On paper, the bill empowers the center to throw out members of an SERC if they willfully violate the act. Determining such a violation can often be subjective and therefore open to abuse. These two rules can damage the independence of regulators while potentially centralizing power to an extreme. Lastly, the bill is doing away with industrial cross subsidies gradually over the next 5 years. Given that industrial consumers are leaving the grid, taking their subsidies with them, this makes sense. For farmers and low income households, subsidies will continue, but will be drawn from the state budget instead of hidden tariffs. This, the government hopes, will reduce the costs of rail freight and improve the competitiveness of our MSMEs. Now, beyond these areas, the bill importantly mandates that discoms procure a minimum share of their power from renewable sources, flouting which can result in penalties. It also establishes universal service standards for reliability and quality, formally recognizes energy storage systems under the Electricity Act, and so on. So here's the bottom line. The draft Electricity Amendment Bill encompasses procurement rigidities, tariff distortions, cross-subsidy unsustainability, and federal friction in one legislative package. That's extremely ambitious. However, this ambition doesn't come without concerns. For one, there's plenty of uncertainty on whether the bill's competitive framework will function as intended. Secondly, there's a fear that the changes proposed could raise prices significantly for the average Indian. There's also a hesitation that the bill overcompensates the center with too many powers. Some states have indeed expressed their dissatisfaction with the bill. It is certainly still a work in progress, but there's no denying that, any which way, India's power distribution direly needs changing. Our electricity future hangs on whether this intent translates into the right kind of change. Coming to the second story. 2025, as you've probably heard 1,000 times so far, was the year global trade seemed to fall apart. The year saw the United States mount a far reaching worldwide tariff war along with a series of other trade restrictions. As others responded globally, the level of trade restrictions reached a point it hadn't in decades. Trade networks developed over decades abruptly fell apart, and earlier this year, you could be forgiven for wondering if we were entering a phase of deglobalisation, where countries would retreat from international trade and their businesses would only serve their own consumers. But that isn't what happened. Although this has been a major stress test for the global economy, the system hasn't collapsed. Instead, it's adapted to its new constraints, bending and rerouting to meet new challenges. So every year, a team of global economic organizations, including the World Trade Organization and the Asian Development Bank, publishes a global value chain development report. This report looks at how global value chains have changed in the preceding year. Naturally, this year's edition, a 450 plus page behemoth, has a lot to chew on. Its message, though, isn't altogether pessimistic. Now, we can't cover every detail the report goes into, but here are some things that caught our eye. Let's start with how 2025 has moved the global picture. The big global economic story of the last few years is one of fragmentation. A decade ago, the world felt like it was slowly turning into a single large global economy. But since 2018, that picture has been collecting fractures. Starting with the first US-China trade war, geopolitical rivalries began spilling into the domain of trade. While countries are still trading across geopolitical lines, the amount of such trade began to decelerate. So, the worst episode, according to the report, came in 2022, as many trading ties broke once Russian troops marched into Ukraine. Things stabilized briefly through 2023 and 2024, but the first half of 2025 re-accelerated that fragmentation. The year saw the world's largest trading partnership, the United States and China, pulling apart faster than ever. But crucially, this doesn't signal an end to global trade. Coming to how trade adapts. When old trade links break, the bilateral trade between countries naturally wanes. For instance, when the United States ramps up trade barriers on countries like China or India, it imports less from those countries. Similarly, if Europe cuts its oil purchases from Russia, they trade less. And so, some features of the globalized world we once knew have already disappeared. Europe, for instance, severely curtailed its reliance on Russia for its energy needs, revising a trend that began with the collapse of the Soviet Union. But lower trade between some countries isn't the same thing as reduced globalization. The broader model of global value chains, of large international production networks where different tasks are performed in different countries, is almost untouched. At its peak in 2022, 48% of world trade happened through global value chains. Now it's declined to 46.3%. For all the chaos of the last few years, globalization is functionally untouched. It's close to the highest it has ever been. Instead, global value chains are adopting new forms. The biggest such adaptation, perhaps, is the rise of connector economies like Mexico and Vietnam. We'll get back to that soon. Let's look at how services now lead globalization. So, there are some facets of globalization that have almost been unaffected in the recent chaos. While goods trade has been difficult in some quarters, trade in services, especially digital ones, continues unabated. And this shift has been in play for a while. In fact, over the last 5 years, services have consistently been the most important component of global value chains. Many, especially those like finance or information technology that are delivered through the internet, have also been more resilient than goods in the face of shocks like the COVID-19 pandemic. As the world sours on goods trade, services could become a shock absorber. So here's what to expect in this new world. But that said, the fact that globalization isn't dead is probably no surprise to you. If you've followed us for a while, you probably also realize that businesses and economies are endlessly flexible and routinely find ways out of impossible looking situations. So, the more interesting question is, what are the specific adaptations they're coming up with in a time like this? Coming to an era of connector economies. So, the fragmentation we're seeing today has a common feature. Countries that consider themselves geopolitical rivals are beginning to see the direct trade between themselves fall. The report explores global blocs based on their UN voting patterns and finds something interesting. Since 2017, trading activity within a bloc has grown by roughly 4% faster than it has across blocs. The starkest example of this lies between the US and China. Since 2018, when their trade war began, their trade with each other has grown approximately 30% slower than their trade with the rest of the world. Now, these global divides aren't absolute. The fact that the US and China are decoupling doesn't mean that all their trade partners are decoupling as well, but quite the opposite. Many countries are successfully positioning themselves between feuding nations, and in doing so, they can become connectors, conduits through which goods flow between countries that don't see eye to eye. For instance, until 2024, Mexico turned itself into a conduit for Chinese goods to enter America, becoming its largest trading partner. Similarly, Kazakhstan helped to heavily sanction Russia buy goods from the world. And in 2022, once Russia was technically cut off from the European markets, its imports from Kazakhstan went up nearly 83%, just as the latter suddenly stepped up imports from the EU. Now, this doesn't mean connector economies are blindly rerouting goods from one country to another. More commonly, they're stepping into small roles in the value chain like assembly or packaging. Becoming a connector, it appears, could be the first stepping stone into integrating oneself into a global value chain. Let's talk about investing in resilience. So, there's another side to this. As uncertainties rose, many businesses began blindly diversifying to suppliers from other countries. According to one survey in 2022, 62% of enterprises tried changing their supplier base. Ultimately, however, many of these changes turned out to be entirely cosmetic. While the medium countries substantially increased the number of trading partners, the number of their meaningful trade relations, partners with more than a 1% trade share, barely changed. As the report explains, it only makes sense to diversify to a new trading partner if they're less brittle than what came before. This is why narratives like China plus one don't automatically result in new business opportunities. Other economies need to be ready to meaningfully replace old suppliers. So, the report introduces a new framework to evaluate potential suppliers, which it calls the Global Value Chain Readiness Index. We won't go into the index here, but the key insight is this. A good replacement supplier should have everything from good connectivity to short customs clearance times to easy permitting to access to financing. And without that sort of readiness, the opportunity doesn't really exist. The current spate of uncertainty has, for many countries, felt like a crisis. Many have responded through industrial policy, and as trade relations break down, there's a rush to onshore the production of important things chips, green technology, batteries, and the like through generous incentives. The report notes that recent industrial policies have been unprecedented in their scale and scope, especially as the WTO has grown weaker. Now, it's hard to really know how to even understand the impact of these policies. Modern economies are simply too complex. So, here's one example. Some time ago, China started subsidizing its local shipbuilding industry, even though it was far more inefficient than its competition in Japan and Korea. As these government backed Chinese builders began crowding out their rivals, the global price of ships fell, making shipping approximately 6% cheaper. That was unexpected good news for China. As the world's biggest manufacturer, cheaper shipping meant that other Chinese exports grew by approximately 5%. Funnily, every dollar of subsidy they gave only generated approximately 18 cents of profit for Chinese shipbuilders. As industrial policy for shipbuilding, the returns are mediocre, but it gave a lot of business to Chinese manufacturers and their customers abroad. So, did the policy succeed or fail? So, there's an interesting, somewhat counterintuitive outcome of the global uncertainty. The number of trade deals have increased. These aren't the broad, all inclusive deals that happened before, where countries would try and set the overall terms of trade between themselves. Instead, these are narrow agreements that target something very specific, like cooperation in critical minerals or technology. In the last 5 years, the number of critical minerals related deals have gone up approximately 15 times. The number of digital trade agreements over the same period have gone up approximately 35 times. Now, these deals are less ambitious than the sweeping trade agreements countries would aspire for, and that means their effects are very different. For one, many of these are hastily patched together. They often don't have any binding commitments at all. In practice, unfortunately, that sometimes means these deals generate very little trade. The most successful of these deals are between entities that already have strong trade ties and whose economies are already meshed into each other. If the countries signing a deal already have a regional trade agreement in place, the new deal is more than 8 times more likely to succeed. And this has an interesting outcome. As countries that trust each other grow closer ties, the global economy can come to resemble a patchwork. So, where does India sit? There are a lot of themes the report covers, and there's much that we haven't gotten to. But before we leave, we wanted to run through a few things it says about India. India has broken into the world's top 10 countries in terms of the value they add domestically to their exports. Roughly 2.8% of the value added in the world's export basket comes from India. And much of this is on the back of our service exports. The WTO does a detailed assessment of India's readiness to take on global value chains, and our performance varies wildly across criteria. For instance, we've been rated highly for our financial reserves or for our logistical performance. Surprisingly, the report even assigns us rank 1 on its Business Climate Index. Meanwhile, we do exceptionally poorly on many criteria, including the capacity of our firms, our energy infrastructure, and our financial depth. The report also recognizes India as one of just 16 countries it studied where global value chains are persistently lengthening. That is, we're one of the few parts of the world that's steadily taking on deeper and more complex parts of global production. Now, coming to the tidbits. JSW Energy is setting up wind turbine blade manufacturing units in Gujarat and Karnataka, expected to produce 700 to 800 blades annually. The facilities will serve both JSW and its Chinese partner Sani Renewable Energy. Coming to the next tidbit. JP Morgan will occupy a 2 million square foot facility in Mumbai's Powai by 2029, housing 30,000 employees. This will be Asia's largest global capability center, backed by a $1 billion investment from Brookfield. Coming to the final tidbit, Jared Kushner's Affinity Partners has withdrawn from Paramount's $108.4 billion hostile bid for Warner Brothers Discovery. The studio's board is expected to reject the offer, favoring Netflix's $82.7 billion deal instead. We recently covered the economics of this whole deal on the Daily Brief. You can check out all the links in the description. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.